And so if that was true, then why would there, the stock market that's supposed to be another very big indicator of the health of the US economy, which it is, and it should be treated as such. I just think that what we're seeing is false. The numbers are false. And the reason is because of all the money that was printed in 2020 and 2021 due to the COVID crisis. More money was printed in that period of time than all of the years past before it. More money was printed during COVID than all the money that's ever been printed in previous history before that. And so where does that money end up? Well, that money becomes spending money for consumers. And so they start buying toys. They start buying, secondary real estate, rental properties. They start buying goods at the store that they don't necessarily need. It's consumer discretions, right? They're just buying whatever they can. And then ultimately what happens is that affects the bottom line of these larger corporations. And then they report their earnings. And then people have money on the sidelines because of that money as well that's been sitting there that they've been waiting to spend. And then they invest it in the stock market. So we have this very hyperinflated stock market. And in my opinion, right now, it's a very false indicator of like what actually is going on. And if you look at it, the fact that the stock market just in the last 2 years, the S&P 500 is up 50%. But what you don't understand is that that's recent. That doesn't mean that's what it's going to do every year. It's not going to provide a 25% annual return. Since inception, 1957, the average return of the S&P 500 is just over 7%. That's it. And while there are very big years, there's also very big drops. And I think that's really the key to understand is that if you can take a portfolio and rid it of those big losses and just get a healthy average return over time, but rid it of those losses, the average return and the total balance can be very, very handsome at the end of that race. And the key is mitigating that 24% decline when the markets are down 24% of the time. If you can avoid those, you can have peace of mind while also having a very handsome balance at the end of that journey. And that's where I want to really share this chart with you, just to give an example of what this would possibly look like if you were to have something like this in your portfolio. Did you want to add anything there, Zach, before I shared my screen?
No, let's share that. I'd like to speak to what you've got here.
Okay. So share.
This is where if you are listening to the podcast and only listening to it, if you've got the ability to pull up the video and see it, it's really valuable information. And if you're a conservative investor like I am, admittedly, you're going to love this. And if you don't, you must not be seeing it the way we are.
Can you see my screen, Zach?
Yeah, we're good.
All right. So what this is a chart or a graph that's modeling out the traditional S&P 500. So these are the real returns annualized over a long period of time from 1998 to 2024. So just to last year. And the point of this chart is to show the real returns of the S&P 500 modeled alongside a fixed indexed annuity that was linked to the S&P 500, but had a 10% cap rate. So every year, the most it could earn each year was 10%. And so I've mentioned it on previous episodes. When you look at a fixed indexed annuity on a graph, it kind of looks like stair steps in a way, because you don't have any losses due to the contractual guarantees of principal protection. So in any negative years, you just earn a zero. So it's just a flat year, okay, on a graph like this. And so the green line is representing the fixed indexed annuity with the 10% cap on the S&P 500. And the red line is the pure S&P 500, the real returns. And there's a couple other colored lines on here. There's a blue line, which is just a 4% fixed rate guaranteed each year. And then the yellow lines is representing what's called a minimum guaranteed surrender value, which is commonly associated with an annuity. But in this example, it doesn't really have any relevance. So when we're looking at this chart, right, from 1998 to 2024, what's interesting is you'll notice in the earlier part of the graph from 99, which was the peak of the S&P 500. And by the way, these balances, it's starting with $100,000. So $100,000 going into the S&P 500, 100,000 going into the fixed indexed annuity with the 10% cap. But what's interesting is if you go to the 1999 line there, you'll see that was the peak, the initial peak on this graph for the S&P 500. So, but what happened shortly thereafter was what we call the dot-com bubble. It burst. So the tech stocks all plummeted, and over, I think it was like 50% was lost. 50% lost on the Nasdaq during that time, from 2000, 2001, and 2002. So you see the big drop. Do you see that, Zach, where the line just goes straight down almost? And then when you look at the indexed annuity, during those 3 years, it just went straight across. It just went flat because of that contractually guaranteed 0% floor. No losses could be incurred there. Going to 2002, you'll see that's when the S&P started to recover, or not this S&P started to recover there. And then you'll see the green line obviously going up. Well, if you look at this and how many years it took for the pure S&P to get back to even, it took an astonishingly long time. We're looking at 7 years. While the slow and steady green line with the indexed annuity with the 10% cap rate just steadily climbing. And you'll notice that 2007 year when the S&P basically just got back to even, you'll notice the balance. Remember, it started with 100K. In 1999, at the peak of the S&P, it went up to 119,526. And then all the way back in 2000, fast forward to 2007, it got up to 119,454. So basically back to even. Well, guess where the indexed annuity is? It's at 154,698. So a significant difference because of that guaranteed floor, principal protection, and the fact that we're mitigating that loss. We're avoiding or ridding ourselves of those drops in the market. So long story short, over the next, from here on another 16 years, while the S&P continued to climb and ebb and flow, you'll notice that in 2007 and 8, that big drop happened. But then fast forward out all the way to now, 2024, and this chart ends with the indexed annuity actually being higher, the ending value, higher than the S&P 500,